Hello guys, today is 17 July, just giving you a trading update. And today the market has pretty much done absolutely nothing, currently sitting at 6,000 points, that's dropping about 1/10 of 1%. Well, the market has been a sideline market over the past month, and then it's kind of really boring, I would say. As I told you before, I'm running a cover call position to benefiting this sideways market. And today I want to talk about several strategies that you can also benefiting from the sideways market. There are a number of things that you can do, such as the calendar spread, double calendar spread, iron condor, short strangle, short straddle, cover call. I don't have that much time today, so I'm only going to talk about the calendar spread, double calendar, and so the cover call. So let's begin with the calendar spread. The calendar spread is constructing by selling the front month option and also buying back the later month option. The way you can make profit on this strategy is that because the front month option decay much faster than the later month option, and also you can also benefiting from this strategy is if the volatility expand, but I will talk about that later on. So I'm selecting the 6,000 strike to give you a demonstration on this. This is all the live market data. I'm using the 30 July option as my front month, and then also using the August 20 month as my back month. So if you can see from the diagram, the maximum profit you can achieve from this strategy is about 58 points. Your break even at current volatility, which is 21.6, is at 58.50. And so this one should be 61.50, I think, roughly estimate. The problem I think with the calendar spread is that you can see your profit window is really small. If the market making 150 points in either directions, you are in risking losing money. But the main reason I think lots of people doing the calendar spread is that you can benefiting from the expansion of the volatility. Let's just bring out the volatility chart, XVI. So if as demonstrated in the coronavirus crisis, the volatility started to increase exponentially to 55 during the pandemic. So if the volatility, let's say, increase from 21.6 to 30, your maximum profit will increase to about 106, but that's probably unrealistic to expect because volatility only increase when market dropping like hugely. So you're probably gonna making, I would say you're probably gonna making only 25 points. But your break-even point also expanding if the volatility increase. But the problem with also the volatility, the calendar spread, you have to be careful is that if the volatility drop, let's say from the current 21.6 to 16, your window will getting smaller and smaller. Your maximum profit is probably only about 26 points, and then your break even is about 59.50 and then 60.50. So the thing about the calendar spread is that you really have to expecting a drop in the share market, also an increase in the volatility. If the market doing exactly opposite what you're expecting, you will be losing money. So I would say this is actually a really small window of opportunity for you to make a profit. I run this strategy like over the past 2 years. I found I would say I don't have that much success in this kind of strategy. So some of the expert in this industry doing what they call like a double calendar. A double calendar is pretty much very similar to the calendar spread. The only difference is that you're adding another leg. You're doing the calendar spread, you're only using the put option or the call option, but we're mainly using the put option because the put option benefiting a lot from the increasing volatility. Call option also benefiting, but doesn't really have that much effect on the put. So if you're doing the double calendar, you are selling 100 points below the current point, and then selling another 100 points above the current strike. I'm currently selecting the 59,000 strike and the 61,000 strike to demonstrate for you guys. As you can see, if you're doing the double calendar, your maximum profit is achieved when the market exactly falls to 59,000 all increased to 61,000. That gives you about also 58 points. If the market stay between 59,000 and 61,000, you're pretty much making around 46 or 43. That's that's pretty much you can make. And this strategy, I think, is better than the single calendar spread. Is that your profit window of opportunity is bigger than the last one, because if the market moving around this range, you pretty much make same profit. As you can see, if the market, if you are trading on the calendar spread, your profit will start to decrease by a lot if the market dropping or increasing. This strategy is also benefiting from the increased volatility, same thing as the calendar spread. It's just demonstrating. Yeah, so that's pretty much the same thing. Now let's talk about the cover call position. This is my preferred way to benefiting from this sideways market, is because I think this way gives you the most flexibility out of it. The cover call position is pretty much very simple. You're just buying one underlying stock and then selling the one call option at the strike, or at the money, I should say. Well, you don't have to sell it at the money, but I will talk about it later on. So if you're buying the one underlying right now at 6,000 and then selling one call, 13 days to go, that's the 30th July, your maximum profit is 93 points, and it's achieved so long it's about 6,000. And if it goes to 65,000, that's still the same. This is, I think, is better because you're benefiting from if the market is staying flat or increasing. You're only losing money when the market decreases. Well, if you look at the calendar spread or the double calendar, the only way you can make money is the market stay within the range. So your window opportunity is really small, and also the profit potential is smaller than the cover call. This is even before the commission. I mean, the commission on the option is very high in Australia. And what I mean by flexibility is that if you're running a cover call, right, you can increase in your profit potential if by selling a higher than the current market point. For example, if you're selling the 61,000 strike, your maximum profit will increase to 153 points. And conversely, if you want to get more protection out of it, more protection against the market moving against you, you can selling like 50 points below the current market. Well, your profit will get smaller, but your break-even point will also be lower, and you get more protection because you're getting more premium out of it. And also, I think I like about the cover call is that if the market moving against you, you can roll down. You can choosing if the market moving against you. That this is what I often do is that I'm actually, for example, if the current market dropping from 6,000 to 59,000, I will just close out the 6,000 point and then selling another call option at 59,000, and then I can still make money out of it. And so this is why I really liked about the cover call position. There's nothing wrong. I would say there's nothing wrong with the calendar spread, but based on my personal preference and also my past history, because I've run the calendar spread like 3 or 4 times over the past month, it has really not been successful. So I really prefer, I would say that the cover call position is really great way to make a profit for like individual investor. So I think that's pretty much it for today. I will give you more update in the next video. Thank you guys. See you next time.